socks tucked into pants, aggressive chest waxing, and I forgot Kevin Hart is in this film.
This your boy?
I'm Peter Billigus, and this is Money in the Movies. Hello and welcome to the Peter Billigus channel's Money in the Movies, a show where we review films based on their financial accuracy. Today's movie is The 40-Year-Old Virgin, directed by Judd Apatow and starring Steve Carell, Paul Rudd, Seth Rogen, Jane Lynch, Catherine Keener, Romany Malco, and, well, there's a lot of people in this movie. The film follows the story of Andy, a somewhat solitary soul
Now I am making your silver pants blue.
who works in a local electronics store.
Welcome to Smart Tech.
But Andy has a secret that he doesn't want anyone to know.
Are you a virgin?
Once Andy's big secret is out, his gang of goofballs jump in to help him lose his innocence.
Okay, have a good one.
Jane Lynch also offers her assistance.
I'm very discreet, but I'll haunt your dreams.
After a series of bookstore pickups, speed dating, and some aggressive chest waxing,
I hate you, stop smiling!
Andy finally confesses his secret to Trish, the one woman he really cares about.
I'm a virgin.
Andy and Trish decide to get married as one final celebration of his celibacy, and then this happens.
Hey, I'm not gonna be done buffering the marble for about a half an hour, but you can come in and sit down if you want.
But this show is money in the movies, not modesty in the movies. So what's going on here in a financial sense? Well, we are most concerned with this scene. Trish asks Andy about his dream. Well, he says,
I'm thinking lately that maybe I should open my own store.
Trish then suggests that Andy sell some of his collectibles to raise money for the stereo store.
You can make a lot of money. I just sold the guy's G.I. Joe for $1,000.
You see, Andy has been collecting collectibles ever since he was a kid. But unlike most children, he never even took his collectibles out of the box.
It loses its value if you take it out of its packaging.
A collectible is something of value that is worth collecting. Collectibles can be wine, paintings, antiques, baseball cards, comic books, or in Andy's case, toys. And Andy has quite the collection.
Is that the $6 million man's boss?
That's much more valuable than Steve Austin.
So Andy plans to sell his collectibles to raise cash for his stereo store. But if you own a collectible and you sell it, is that taxable? And how are you supposed to calculate the taxes on that collectible? Or how about this? If you have a yard sale and you sell a bunch of your stuff, do you need to pay taxes on that? If you sell it on Facebook Marketplace, do you need to pay taxes on that? Well, the short answer is, in most cases, if you buy anything and sell it at a higher price, there will be taxes due. Let's say you buy a car for $10,000 and you sell it for $12,000. In this example, the $10,000 you paid for the car is known as your basis. The $12,000 is your sales price. The difference between the two, the $2,000, is your profit, aka your gain. In this case, there probably would be taxes on the gain of $2,000. Now, when it comes to cars and yard sales and Facebook Marketplace, taxes usually aren't an issue, for the simple reason that people buy these things at one price and sell them at a lower price. There is no gain, so there is no tax. There's also no tax deduction, by the way. But there are purchases that we make where we buy something at one price and we sell it at a higher price. If we hold these purchases for more than 1 year, the proceeds of the sale most likely create capital gains taxes. Let's break this down. Capital, in this case, is an asset. An asset, in this case, can be anything that you own. Gains equal the increase in value, and taxes are fees paid to the government for services. So when you buy something at one price and sell it at a higher price, there are usually capital gains taxes. I say usually because there are some exceptions. For example, if you buy a home and live in it for at least 2 years and then sell it for a profit, there's a good chance that most of that profit will not be taxable. If you buy a piece of investment real estate and then sell it for a profit, you can delay your taxes using something known as a 1031 exchange. This tax strategy allows you to delay paying taxes on the profits from a real estate sale if you purchase another property with those proceeds within 6 months. And of course, if you are buying and selling inside a retirement account, such as a 401k or a Roth IRA, there are no taxes due until the money is withdrawn from the account. And in the case of the Roth IRA, there may not be any taxes at all. But while there are exceptions, by and large, when you buy something at one price and sell it at a higher price, there will be capital gains taxes due. In the case of our 40-year-old virgin, he is selling toys that he got as a child, and he is making a big profit off of those toys. But how does he calculate profit or gain for tax purposes? Remember, the equation is sales price minus basis equals gain. How is he supposed to determine the basis of those toys? I mean, if he got the toy as a gift when he was 8 years old, how does he figure out what the original value was? Well, here's the simple answer. If you truly don't know, it doesn't really matter. Here's what I mean. I did a little research and I found that in 2021, a 1979 Millennium Falcon spaceship with a grade of AFA 80 plus NM sold for $42,834 at an auction. Now, this toy was still in the original box, factory sealed and professionally graded, a very, very rare item. Now, in the year 1979, that Millennium Falcon sold for less than $30 in the toy store. So in this case, our gain calculation would be $42,834, our sales price, minus our basis of $30 for a total gain of $42,804. Now, at the time of this filming, the capital gains tax rate for collectibles, not every asset that's collectibles, is 28%. Collectibles have their own special capital gains tax rate. So our tax rate is 28% of $42,804, or $11,985.12. But let's say we couldn't find the basis of the Millennium Falcon. What then? Well, in this case, you can estimate the cost, providing costs of similar toys, and the IRS might accept your basis. Or you can play it safe and simply state there is a zero basis. In this case, the total tax with the basis was $11,985.12. And without the basis, it's $11,993.52, a difference of only $8.40. It's not worth the risk. If, on the other hand, you are a serious collector, then you would know the basis of everything you buy. Thankfully, with the internet, it is much easier to determine the basis of toys and look up historic prices. If the toy was given as a gift, then your basis is the value of the toy on the date that you received it. If you inherited it, it was the value of the date of your inheritance. And if you yourself purchased it, your basis is the purchase price. So what can you and I learn from Andy's experience?
When the moon...
I mean his financial experience. Well, this reinforces a theme that I have stated over and over again. If Andy did anything wrong, it would be that he sold his toys first, and then, I'm assuming, he will file a tax return later. The only problem is by then, it's too late. The toys are already sold. Andy made the common mistake that so many people make. They do something first, and then they talk to their accountant. Or they do something, and then they file their tax return. What we want to do is call the accountant first, then do the thing we were planning on doing, using the strategies suggested by our accountant. For example, Andy could have formed a limited liability company, or LLC. He could then transfer the toys into the LLC, so now the LLC owns the toys. From there, he would be able to deduct business expenses as he sold off his toys. He could write off a home office, or even his car.
I drive a bike.
Or his bike. The point is, taxes are the one place where it does make sense to pay for advice. You can't control the stock market, or the real estate market, or interest rates, but you can control, to a large extent, how much you pay in taxes. But the way to harness this control is to talk to a tax professional first, and then do the thing you want to do. So if you are considering installing a solar array on your house, or buying an investment property, or starting a business, or selling one of your valuable toys, call your accountant first before doing those things. As to the film, there is no mention of the tax consequences of selling these toys, which would be a major issue in real life. Just under 30% of what Andy earned from selling his toys would go to the IRS if he didn't first develop a strategy. Therefore, I give this movie 1 out of 3 dollar signs. If you enjoyed this episode, please hit the like button below and consider subscribing to this channel. And if there is a movie you would like me to review for its financial accuracy, please let me know in the comments below. I'm Peter Billigus, and this is Money in the Movies.